Good morning, everyone, and welcome to this AMAS webinar series on sustainable asset management, a sequence of 4 sessions exclusively for our members on the latest EU and Swiss regulatory developments in sustainable finance. Each webinar will feature expert insights and practical guidance to support Swiss asset managers in navigating the current Swiss and European upcoming regulation. This first webinar deep dive on everything you need to know about Omnibus. As you know, the Omnibus Simplification Package was published by the European Commission on February 26 and introduced significant amendments to the EU sustainability regulations. And for this first webinar, we have the pleasure to get first-hand insights directly from Brussels from our colleague Lukas Paxmarer, policy advisor at the SFC, the Swiss Finance Council. But before we go to Brussels, I'd like to pass on the floor to Adrian Schatzmans, our AMAS CEO, for some introductory remarks.
Thank you, Aurelia. Good morning, and I promise I keep myself very short. But just to share a bit my excitement, as Aurelia said, this is the first webinar of many more to come. And why do we do this? We obviously know how important the regulatory environment in the European Union is. And for this reason, we have massively strengthened our footprint in Brussels. We have beefed up our collaboration with the Swiss Finance Council. We even have a colleague in Brussels now with an AMAS hat. And we have expertise today with Lukas in the field of sustainability. We will have expertise in the field of technology, and with Maxime Mahler, an AMAS colleague who kind of oversees the developments for the whole asset management industry. And this collaboration should have two directions. One is what we do today. Our colleagues in Brussels, they tell us, they inform us, they make sure that we know everything that we have to know about developments today in the field of sustainability. But the other direction is equally important. Use our colleagues in Brussels, use these resources, tell them what we need here in Switzerland, what we need in terms of advocacy, what our priorities are, what our positions are. So if we do both information and advocacy together, I think we will have a very, very powerful combination. And I'd like to thank upfront all my colleagues in Brussels today. It's Lukas, but equally the whole team. We have started this just a few months ago, and it works very well. And as Aurelia said, there's much more to come, not only in the fields of sustainability, but in the fields of technology, for general asset management topics. And I can tell you, I look very much forward to this. And with this, Aurelia, back to you.
Thank you very much, Adrian. And with that, I think we can go directly to Brussels with Lukas, as I mentioned, who is our policy advisor focused on sustainability at the Swiss Finance Council, to deep dive on the topic of today, the Omnibus Simplification Package.
Thank you very much, Aurelia. I hope everyone can hear me fine, and it's a pleasure to be here with you today. And of course, I can only piggyback on what Adrian said. I think it's a very valuable collaboration between us, and I think it's very much, useful for you to have a sense of the ongoing discussions that are currently taking place in Brussels. In that sense, I would like to structure my presentations sort of around making sure that you get an understanding of what is being discussed at the European level, how the co-legislators and the broader ecosystem is reacting to the proposed package, and lastly also touch upon the implications that come with said package, and finish by sort of outlining the implications for Switzerland, but also in particularly for Swiss asset management. So without further ado, I would quickly like to maybe touch on the ordinary co-legislative procedure that the EU foresees for such files, in particular sort of since we are looking at an active file under discussions. So I'm assuming that most of you would be aware of this to an extent, but I just wanted to give a quick refresher. As you would know, usually, and I think this also goes to highlight that in the case of the Omnibus, we've seen some notable divergences from the usual process. But in the usual process, the Commission, after sort of consulting with the wider ecosystem and relevant stakeholders, initiates a legislative proposal, which then passes on to the Council and the Parliament. Within the Council, it's usually technical working groups dealing with the files that can be escalated in case of need for higher level political discussions and eventually also adoption of the Council negotiating position on a certain file. On the Parliament side, the situation is a bit more complex in the sense that the Parliament then or usually assigns a new legislative file to a committee, and the political groups hash out rapporteurs, so essentially the responsible MEPs for a file, as well as so-called shadow rapporteurs from other political groups, which are then in charge of crafting a first draft report within the responsible committee. Within said committee, the MEPs of that, or the members, are then free to introduce amendments which are voted upon in said committee, ultimately producing a draft report that passes on to the plenary, where again there is room for introducing amendments, but ultimately sort of leads to the vote on the Parliament's position on a certain file. Once both are finalized, or both legislators have finalized their respective perspective on a file, the EU uses a so-called procedure called the trilogues or trilogue negotiations, where representatives of both co-legislators and the Commission try to find a compromise on a given legislative file. If an agreement can be reached, the file then passes back to the broader co-legislators, which rubber stamp the agreement, and after which it can enter into force and pass on to the implementation phase, where directives need to be transposed into national law, of course, whereas regulations are directly applicable across the European Union. And oftentimes, especially in the financial services field, a new legislative files often comes with a number of mandates for lower level legislative initiatives that are primarily sort of in the remit of the Commission. So this sort of the overarching, let's say, regulatory context of the EU's decision making. I would now propose to move sort of to the current broader environment in which the EU finds itself in, and which is crucial to understand where the Omnibus package on sustainability has derived from. As you would have heard, likely 2024 was sort of the big year, or one of the big years, for the institutional changeover of the EU, where we saw both the European elections, of course, but also the new election or the re-election of Ursula von der Leyen as the Commission President. And there I would like to highlight a number of sort of key trends that then build sort of the case for the EU's simplification push. And for one, we see sort of on the, let's say, on the institutional side, a strengthening of the position of the European People's Party, the center-right party that notably also hosts Commission President von der Leyen. And as such, the EPP remains, let's say, as the linchpin and has been sort of the motor behind the EU's simplification push. Tied to this, we also see a surge in far-right political groups, but nevertheless, the centrist majority centered around the EPP, the Greens, the Socialist Democrats, and the Renew political group remains, let's say, the overarching majority within the Parliament as well as the Council. So this sort of the institutional background against which we increasingly see the EU facing, let's say, broader geopolitical and tensions, first among them, of course, sort of personnel changes, let's say, in jurisdictions of relevance to the EU, broader geopolitical tensions, of course, the wars on the doorsteps of Europe, but more generally also sort of a lagging behind of the EU economy behind, let's say, behind relevant competitors such as EU and China. And this has now, over the sort of last year culminated in a sense that the EU needs to deviate from its earlier, let's say, EU Green Deal push towards ensuring competitiveness. And so we see now a sort of dual priority approach that is prevalent both in Ursula von der Leyen's political program, but also in the Draghi and Letta reports that have accompanied the institutional changeover of the EU. So that being said, that the new competitiveness angle that has been introduced also builds the basis for the broader simplification push, where the EU more and more converges on the notion that in order to be competitive at the global level, the EU needs to simplify its regulatory framework, which has been argued to constrain the innovativeness and the prosperity of the broader EU economy, both the real economy, but also financial services. And maybe just to throw some numbers out there to illustrate this point, and let's say the awareness that is currently broadly shared in Brussels. I mean, the fact that the EU since 2019 has passed 13,000 laws compared to 3,000 in the EU illustrates this regulatory overburden that it is often framed as, and which has now been acknowledged also by policymakers, and most notably, of course, by Ursula von der Leyen as the figurehead of the new legislative mandate. And this in turn has led to this simplification mandate be reflected in the overarching policy documents that underpin the new mandate. First among them, of course, the mission letters that went out to the respective commissioners, but also the competitiveness compass, which outlines a roadmap to restore EU's position on the international, let's say, scale, but also the omnibus packages, of which the one that we are talking about today, the sustainability one, is a part of. And this then goes sort of this essentially, all these measures together seek to reboost European competitiveness and essentially make return the EU to a, let's say, competitive environment for businesses. So this is the broad institutional context against which the EU simplification packages have to be understood. But I want to emphasize here that while this sort of derivative approach to simplification based on a bid to increase competitiveness may make sense from a hindsight perspective, the introduction of the omnibus packages as a whole, and particularly in the case of sustainability as the first one, has been associated or characterized with a quite chaotic lead up, in the sense that while the simplification mandate was broadly shared among policymakers, the first omnibus package was unilaterally announced by Ursula von der Leyen in November at a press conference, which not only caught the wider ecosystem quite by surprise, but also Commission services, which then went into a fury or a frantic scramble to put together corresponding proposals. Which is also reflected in the positioning of the respective actors, where we saw member states, MEPs, the industry, but also civil society stakeholders weighing in on potential ideas and approaches to simplifying the sustainability framework of the EU. Here, a fact that I would like to highlight, and which has been the subject of quite a number of criticism, particularly from the NGO side, is the fact that the Commission has adopted, or particularly Ursula von der Leyen adopted, quite an ambitious timeline, which essentially led to the Commission skipping the impact assessments, which are classically foreseen under the EU's better regulation approach, and had instead opted for holding simplification roundtables with quite a targeted participations, primarily inviting industry stakeholders, but also some civil society representatives. So Eventually, this then led to the publication of the proposal or the package on the 26th of February, and essentially also paved the way for a wave of further omnibuses, of which I think currently we're standing at the fourth, or we're looking at the fourth omnibus, with at least a fifth one scheduled for adoption ahead of the summer, and many more reportedly in the works within the Commission services. So the omnibus, let's say, as a buzzword and as a legal, has emerged as the legal vehicle of preference for the EU's and the Commission's simplification push. Having said that, I would now like to turn to the subject of today's talk, namely the Omnibus Simplification Package on sustainability, which can be argued to be composed of four core components. For one, we have the Stop the Clock Directive, as it is commonly termed, which aims to provide legal certainty ahead of the broader changes introduced as part of the Substance Omnibus Directive. And thirdly, we also have an accompanied revision of taxonomy delegated acts. This, however, differing in the sense that we are looking at a level 2 proposal and not a classical level 1, so ordinary co-legislative procedure. And similarly, as the fourth element, as part of the substance proposal, the Commission also committed to revising the first set of the European Sustainability Reporting Standards. This in line, of course, with the changes introduced as part of the CSRD, so the Corporate Sustainability Reporting Directive. I will go into details of the respective changes introduced in a second. Just want to caveat this overview with the fact that in addition to these elements, the Omnibus Simplification Package also coincided with a simplification initiative related to the Carbon Border Adjustment Mechanism, the CBAM. However, given that it is sort of treated separately by co-legislators and is not necessarily framed or to be understood in the same context as the measures introduced under the CSRD and the CSDD. I would not focus on it too much today, but I would be happy to take any questions at the end of the webinar. That being said, I would like to jump directly into dealing with the Stop the Clock Directive. The Commission's proposal primarily aims to introduce legal certainty for companies that would be de-scoped under the CSRD under the Substance Omnibus proposal, meaning that the Stop the Clock essentially proposes that the second wave of CSRD entities and the third wave, so the second wave composed of the remaining large undertakings and parent groups that were not covered by wave 1 are scheduled to be delayed by 2 years, as well as the third wave composed of listed SMEs, which are now essentially proposed to only apply in 2 years. I'm saying proposed to apply in 2 years. This, of course, having to caveat with the fact that under the scope amendments, under the substance proposal, these two groups would essentially be de-scoped and would no longer be required to report. So the Commission's intent was primarily to avoid a situation where these companies would have to begin reporting in either 2026 or 2027, and then would be again de-scoped, or would have to stop reporting as soon as the substance proposal is finalized. On the CSDD side, the changes are a bit more minute in the sense that it primarily delays the application of due diligence requirements, essentially deleting the first wave and rendering them equal to the second wave, as well as pushing back the transposition deadline of the CSDD. In terms of legislative treatment, and with view to the Commission's intent to treat this as a priority to provide legal certainty, both co-legislator essentially adopted quite a streamlined procedure to deal with this file. We see on the council side already an adoption of the respective position a month after the publication of the package itself. The council in turn did not introduce any amendments to the commission proposal, but essentially converged on treating wave 2 and 3 companies on the CSRD and deleting wave 1 companies under the CSRD. On the parliament side, the process was a bit more fraught with divergences among political groups, but nevertheless, the votes on using both an expedited procedure as well as the ultimate plenary vote to adopt the proposal as it stands managed to find a majority. But here to flag already that the process around it was fraught by or characterized by a lot of divergences among political groups in line with their positioning on the political spectrum, where in particularly let's say the leftist leaning political groups such as S&D were looking for concessions on the later negotiations on the substance proposal and only managed to come to an agreement hours ahead of the vote on the 3rd of April. Nevertheless, the fact that both co-legislators converged on passing the Commission proposal without any amendments meant that there was no need for trilogue negotiations, and subsequently the proposal was published in the official journal mid-April, which now opened the window for member states to begin the transposition processes in their respective jurisdictions, with the deadline for this being the end of the year 2025. Although this has to be caveated with the fact that a number of member states, prominently among them, of course, Germany, have not yet transposed the CSRD to begin with, let alone the CSRD. So it is quite unlikely that they will transpose just to essentially postpone the requirements again. And it is much more likely that they will instead wait for the finalization of the substance omnibus with view to having a comprehensive framework in place, which on the other hand, of course, is quite worrying for European and non-European companies that are facing significant legal uncertainty, which is a message that has been sort of univocally promoted among respective industry stakeholders. Turning back to the more substantive, as it says in the name, the substance proposal of the Omnibus, I would like to give a quick overview of the most relevant changes, both under the CSRD and by extension the taxonomy regulation, but also under the CSRD. And I'm caveating this, that this essentially constitutes a selection from my side. There are some additional amendments or introduced simplification measures which are likely of a slightly lesser significance, but I'd be happy to touch on those as part of the Q&A later on if ever there is a need for it. So when turning to the CSRD under the substance proposal, one of the most notable changes introduced is in effect the amendments to the application scope. According to the Commission, the introduced amendments would effectively de-scope 80% of companies that were in scope of the original CSRD, as the Commission proposes to raise the threshold for EU companies under Article 19A and 29A of the accounting directives to entities that have 1,000 employees or above, and also satisfy certain turnover and balance sheet thresholds. However, given the sort of the employee threshold, I think the more prominent element of the two is indeed the newly introduced employee threshold, which has also been the element that has received the most attention within the legislative discussions that are currently ongoing. When it comes to the application scope for non-EU parent undertaking, we don't necessarily see the same thing replicated. We do see an amendment of the scope in the sense that the Commission proposes to raise the threshold from 150 million in the EU to 450 million, but only slightly amending, let's say, the threshold test for respective subsidiaries or branches within the union, essentially equaling the thresholds for subsidiaries to the previous CSRD scope, and only slightly raising the branch threshold test to a turnover threshold above 50 million. The changes to the application scope of the CSRD are in turn also accompanied by changes to the CSRD reporting regime. Most notably, we see the Commission introducing a commitment to review the first set of the European Sustainability Reporting Standards, which were published in 2023 and were subsequently applied by Wave 1 companies for reporting on the financial year 2025, but are now subject to review. And I would go into the details of this process that is currently ongoing in later parts of the presentations. Also important for the purposes of financial for the financial industry is the fact that the Commission proposes to remove previously foreseen sector-specific standards, rather sort of outlining that, you know, for now there is no need for them potentially suggesting a approach via non-binding guidelines, but generally speaking, putting forward the notion that a holistic, generally applicable revised first set of ESRS is the way to go for now. This in turn is accompanied by a so-called newly introduced value chain cap, which effectively is intended to protect entities that are no longer in scope of the new CSRD, i.e. entities that are below the 1,000 employee threshold. And there the Commission foresees that such entities could not be forced to divulge any information that goes beyond the new voluntary ESRS that are still to be developed, as well as commonly shared sectoral information, in turn also significantly, of course, or contributing to the availability of data under the EU sustainability reporting regime. The changes introduced as part of the CSRD in turn also have implications for the EU taxonomy, and particularly the reporting obligations under Article 8. For one, the changes to the CSRD application scope effectively change the scope of Article 8 disclosure obligations, since those provisions cross-reference to the CSRD. So now we would be looking there as well at the newly introduced 1,000 employee threshold. Moreover, the Commission proposes to introduce a new optional reporting regime where companies that have a 1,000 plus employees but not exceeding the turnover threshold of 450 million would effectively be able to choose whether they intend to divulge any information related to the taxonomy, this being tied to effectively the choice whether undertakings want to make any claims that their activities are effectively environmentally sustainable activities. In conjunction with this, the Commission also foresees a new mechanism where companies can say that while they don't fulfill all criteria of the taxonomy, some of their activities fulfill partially the relevant criteria, and this effectively is sort of a way to facilitate transition finance. As it stands, the detail on this are still quite fuzzy, and will be further specified in a forthcoming delegated act. On the side of the CSRD, we see a number of quite significant changes. For one, we see the removal of the previous EU-wide civil liability regime. We also see an amendment of the due diligence requirements, so essentially the core element of the CSRD, in the sense that no longer are companies required to effectively perform due diligence assessment and obligations along their entire chains of activities, but rather are required to essentially apply those requirements to tier 1, so meaning their companies, subsidiaries, and direct business partners, and further reaching obligations would only arise in the case of plausible information about adverse impacts along the value chain. Moreover, and this of particular relevance for our purposes, the Commission proposes to delete the financial service specific review clause that would have been due by July 2026, where essentially an extension of due diligence requirements to financial services was considered. As it stands, of course, financial services or financial institutions are only subject to upstream requirements and not downstream requirements under the CSRD. Moreover, on the transition plans, the EU modifies the language in the sense that they no longer foresee the putting into effect of transition plans under the CSRD, but rather say that for now companies would have to adopt the transition plans that outlines respective implementing actions. So in effect, no longer foreseeing an explicit obligation to implement transition plans, but rather more an obligation to have one in place. Nevertheless, I think from our perspective, this sort of adds more complexity almost, and has been also the subject of internal advocacy efforts on this. The last point that I want to highlight on the CSRD is the fact that there are a number of guidelines foreseen, effectively laying out additional requirements or help with regards to the obligations that arise from the CSRD. With view to an adequate implementation period, the Commission notably proposes to at least sort of the core guidelines to front load them to July 2026, effectively giving companies a 2-year window to at least apply said guidelines. So I would leave it at that in terms of outlining what the Commission has intended. And would rather now turn sort of where we stand on the side of the substance proposal in terms of the legislative procedure, and also how the legislative proposal has been perceived by policymakers. So as you can see on the slides, we have sort of a divergence in terms of timelines between the Council and the Parliament. The Council is looking to move quite quickly on the substance proposal as well, with the Polish presidency in particularly pushing a quite ambitious timeline that has now sort of run into some troubles given divergence of views, on which I will touch in a second. Nevertheless, on the Council side, the intent is still to finalize their respective position ahead of the summer break, which would then effectively enable them to take up trilogue negotiations once the Parliament has finalized their position. That being said, on the Parliament, we are looking at a slower timeline. For one, the EPP main rapporteur, Jürgen Warborn, is expected to submit his report in early June, his draft report, which then opens the door for amendments by fellow committee members in the responsible jury committee. And these amendments, as well as the draft report as a whole, would then be put to a vote on the 13th of October, with view to finalizing the position at the end of October, which would then pave the way also for Parliament to enter trilogue negotiations. As you can see from the timeline, we are likely looking for the discussions on the substance proposal lapsing into 2026. So the file will keep us busy for the foreseeable future in any case. In terms of the reception or the positioning of both co-legislators on the file, I would first want to touch on the Council. We see sort of, and this is also reflects positioning ahead of the publication of the package, that member states are broadly supportive of the Commission's intent to lessen the regulatory burden and simplify the EU's sustainability framework. So while initially sort of the conversations were quite unanimous, over the last few weeks, some elements have drawn further, let's say, or have resulted in a need for further discussions. First among them, the CSRD application scope, which of course, as I outlined, is one of the key introduced measures, where we see some member states arguing for more ambition even, whereas other member states would rather see a tiered application scope where certain medium, large companies would still be required to report, but under simplified standards. This in turn is also complemented by continued divergence on the provisions relevant to the CSRD. Most notably, member states cannot necessarily agree on the approach to take on the due diligence requirements as a whole. So the tier 1 approach that the Commission proposed, being contrasted by effectively the risk-based approach that was sort of underlying the initial CSRD regime. On the transition plan provision, as well as on the civil liability regime, we also see some further divergence of views, which in turn contrasts, of course, with certain elements that have received broad support by member states. First among them, sort of the notion that SMEs need to be protected in particular, as well this then translating to the concrete proposal of a value chain cap. Would want to highlight here that for financial institutions, quite relevant is the fact that member states are acknowledging the fact that the implications of the Omnibus for the framework applicable to financial institution needs to be acknowledged. And also we don't necessarily see any member states touching on the removal of the financial services review clause under the CSRD, which from our perspective is an encouraging development. So to summarize, the discussions on the Council side have stalled a bit. So the issues that I've outlined, that where we see a divergence of views, have now been escalated to higher level discussions, and sort of adding to the complexity around this. And as you may have seen in recent news coverage, we have both Chancellor Merkel and French President Macron essentially coming out and saying that they would want to see the CSRD deleted in its entirety, which sort of diverges from their position at the working group level. So it still remains to be seen how they effectively translate to the discussions in Brussels, but nevertheless they make sort of the broader pictures a bit more fuzzy, and we'll have to see exactly how those, let's say, top level comments will effectively shuffle down the hierarchy. On the side of the Parliament, the views on the proposal are as to be expected, in line with the political positioning. For one, we have the EPP as the motor behind this whole simplification push, acknowledging that the Commission proposal is quite a good one, but arguing that certain measures would require an additional level of ambition. Here, I would like to sort of highlight as an example the fact that the EPP is considering pushing for an additional increase of relevant thresholds, both under the CSRD and CSRD, arguing for the alignment potentially at 3,000 employees. This, of course, being a potential negotiating tactic as well. On the side of the ECR, or the far right, we see calls for a even more ambitious approach that would want to see the frameworks deleted in their entirety, which in turn contrasts with the more leftist leaning groups or centrist groups, which broadly acknowledge the need for simplification, but are in particularly opposed to the changes introduced as part of the CSRD. Similarly, of course, to the overview that I've provided on the council side. So as it stands, the situation remains quite fluid on the parliament side. This also due to the fact that discussions have only recently been picked up. So the exact positioning of MEPs on the file is still quite, or is still subject to changes potentially. In any case, I think the core question on the side of the parliament remains how the EPP will position themselves on this, given that they are essentially the kingmaker in the new parliament. For one, they could potentially sort of look to the far right to reach an agreement. On the other hand, this would likely complicate discussions on all other legislative files that are currently under discussions at the European level, so would sour the relationship within the von der Leyen majority. And this in turn is not necessarily helped by the fact that the far right groups are in outright oppositions to the frameworks as such. So I think in my view, the likelier, let's say, path is a centrist compromise. But there, I think a lot of it will come down to the positioning also of the Socialists and Democrats, which have been quite vocally about the shortcomings ahead of the proposal, namely the skipped impact assessment that I alluded to before. So we'll see to what extent they will be amenable to certain compromises. But yeah, I think a lot of it comes down to the interactions between the EPP and the SND. So on this sort of being the overview of level 1 developments, as indicated in the first overview of the package with its 4 core components, I would want to turn quickly to the committed revision of the first set of ESRS, where the Commission now, based on said commitment, has mandated the advisory body EFRAG that also drafted the first set of standards to provide a revised technical advice by October 2025. This process is ongoing. EFRAG is currently consulting with relevant stakeholders and aims to publish a exposure draft at the end of July. So details are still being worked out within EFRAG. But I think from a general point of view, or the Commission mandate gives a clear indication of the marching direction, notably that EFRAG is tasked with substantially reducing the number of data points that companies need to report on. Among said measures, also prioritizing easier to implement quantitative data points, further sort of providing clarity on provisions that are flagged as unclear by stakeholders, and for the purposes of Switzerland, particularly relevant, the fact that EFRAG is also tasked to enhance the degree of interoperability with global sustainability reporting standards. So as a broad encouraging developments from the perspective of Switzerland and Swiss companies, but nevertheless, I think the devil, as always, lies in the details. So we'll need to see how this shapes up over the coming months. The second part on the level 2 is, of course, the revised or the amended taxonomy delegated acts. Here, I would want to particularly focus on the taxonomy disclosures delegated act that notably derive from Article 8, so the disclosure obligations under the EU taxonomy, where the Commission, for one, introduces a 10% de minimis financial materiality threshold, where anything below that would not need to be reported on. Also, for now, the Commission sort of intends to provide an alignment with the measures introduced at level 1, where especially financial institutions would not have to consider entities that are no longer in scope of the new CSRD from reporting on relevant KPIs. And then lastly, another key element, of course, being the simplification of reporting templates, where the Commission argues that the amendments would result in at least 60%, let's say, diminished reporting burden. The subject or the determination to what extent this is actually true will have to be seen in practice over the coming months/years. In terms of timeline, we are looking, of course, at the adoption of a amended delegated act over the next few months, with then application of the amended delegated acts scheduled to apply starting on January 1st, 2026. But here I have to highlight these amendments are primarily considered a quick fix, in the sense that the Commission is, as we speak, working on a broader review of the Disclosures Delegated Act, as well as other delegated acts under the taxonomy. The timeline on this is not necessarily known yet, but will likely also depend on the outcome of the omnibus at level 1. And now maybe turning to a related but not directly part of the Omnibus Simplification Package is the fact that under the new sort of reporting regime on sustainability matters, the Omnibus introduces essentially far-reaching changes that would heavily impact the availability of data that would in turn also be required to meet certain obligations under the SFDR. As such, the Commission has signaled its intents to ensure the overall coherence of the framework and wants to take into account the corporate or the obligations under the amended frameworks. That being said, I think there's a question of timeline on this, as the Commission remains adamant that they want to come out with the SFDR review proposal in Q4 2025, where the legislative discussions on the Omnibus are not necessarily finalized as such already. But I think for the purposes of this community, a very relevant and worthwhile noting development all the same. And ultimately, and I think this sort of brings back or concludes my intervention today, I would sort of want to highlight the key implications for your purposes or for Swiss asset managers, in the sense that, for one, we, of course, all Swiss entities that have a significant presence and as such fall under relevant provisions of the CSRD, the taxonomy, and the CSRD are directly impacted by the introduced changes. So there's, of course, it's definitely worthwhile to monitor the ongoing discussions and intervene through AMAS and by extension the SFC if ever there is sort of developments that go contrary to your business model. More broadly, and this goes in line with the points that I outlined on the implications for the SFDR review, the Omnibus as a whole, as I said, significantly amends the availability of data on sort of the real economy, particularly in the EU, but also beyond to an extent, which will likely need to be reflected across the wider framework, but would of course be also relevant for your business purposes, I would imagine. And then lastly, turning sort of to the interplay between the EU and Switzerland, we of course also see a certain, or the Swiss government has intended to align frameworks with the EU. Now, with the fact that the EU is intending to significantly reduce or revise its framework, the Swiss plans to align, of course, are drawn into questions. And my understanding is that they are currently sort of on pause to be seen how the EU is further approaching this. But of course, this provides a certain degree of domestic regulatory uncertainty also arising from the EU's proposed changes. So this would conclude my intervention today, and I would gladly be available for any questions on this that you may have.
Thanks, Lukas. I think there was one question in the chat. Maybe I read it out loud. Is it ensured that the targeted reduction of company data points does not conflict with the reporting obligations of asset managers?
It's a good question. It's not necessarily ensured by the Commission as such as part of the Omnibus Simplification Package. There are, however, encouragement developments in this regard. For one, we see member states explicitly introducing as part of the recital an acknowledgement that the reduction of data points needs to be considered with view to the framework of relevant to asset managers and other financial institutions. And on the other hand, of course, as I outlined before, the Commission acknowledging this to an extent as well on the recently launched call for evidence ahead of the SFDR review, where they indeed do allude to the fact that they will consider the changes introduced as part of the reporting obligations applicable to asset managers.
Lukas, thanks a lot, both to you and to the whole SFC team for this very, very comprehensive overview of Omnibus. As announced by both Aurelia and Adrian, today's session was the first of a series of 4 webinars. You should have received the invitation. If not, please get in touch for 3 further webinars. So we'll meet again on the 18th of June for regulation on AMAS Self-Regulation 2.1, which will give you an overview of what is changing. So that's the 18th of June at 3 p.m. Then we'll meet again in collaboration with Expert Suisse on the 24th of June at 3 p.m. This one will be dedicated to the audit of the self-regulation. And last but not least, we'll meet also on the 30th of June, Monday at 10 a.m. And there we will examine implementing the self-regulation, early insights, and case studies. A last word maybe before we leave. There are a couple of seats left for our Asset Management Day in Bern on the 13th of June. You'll find all the details on our website. Don't miss out on this great event of the asset management industry. And with that, thanks a ton, Lukas. Thanks all for your participation, and see you soon. Have a nice day. Bye-bye.